La presente década está viendo un crecimiento acelerado del uso de los derivados listados, particularmente en algunos mercados emergentes, mientras que en otros hay muchas oportunidades para crecer. Para entender este panorama, es un honor presentar la mesa panel Growth Opportunities in Emerging Markets for Derivatives Exchange, con los distinguidos panelistas Hatzopoulos, Managing Director Client Development and Sales in CME Group, Geannopulos, former Chairman and CEO in Trading Technologies, Sosnoff, founder of Tastylive, Troy Kane, CEO in MIAX Futures, and as host, Tabb, Director Market Structure Research in Bloomberg. We welcome all them to the Risk Management and Trading Conference 2024.
There we go. I'm Tabb, head of Market Structure Research for Bloomberg, and I want to welcome you to the panel. Our discussion is really going to be growth opportunities in emerging markets. Before we get into the heart of our discussion around emerging markets, want all the different panelists just to kind of introduce themselves a little bit about why they're here, and then talk, I guess, for a second or two about where's some of the growth that they're seeing in derivatives markets. Since we've got some great folks to really discuss this. Phil's at CME. Why don't you introduce yourself and tell folks what you do and where are you seeing some of the growth?
Thank you, Larry, and thank you to RiskMathics for hosting the event and having us here. Again, my name is Philip Hatzopoulos, and I'm head of sales for the Americas for the CME Group. We have an office in Mexico. I come down here at least once a year, once or twice a year, meet with many of the institutions, kind of education training sessions, how to use our products, what we're seeing in the marketplace. We're committed to helping grow the use of listed derivatives in Mexico, and we'll continue with that. As far as growth in the markets, this year it's been an amazing story. You have to go all the way back to 2010, where I could see every asset class has grown, and we've seen that this year, led by our commodities. Agricultural commodities, metals, energy are up double digits. Financials are all up strong as well. And the exciting thing is it's being driven by economic events, macro events, right? Inflation, activity in the markets, people putting on transactions that they need to, and it's not a risk-off. Sometimes you see volumes grow a lot when it's a risk-off environment, but then markets always slow down. So we are seeing growth in all asset classes, and all market participants, including retail, are up this year and using more listed derivatives. And options has been a huge area for us as well. I'm sure we'll talk a little bit about that. Good. But good area of growth too.
Tim, you led a keynote this morning. Why don't you reintroduce yourself to folks, and you're on the fintech side, and where are you seeing some of the interesting fintech stuff happening?
So my name is Tim Geannopulos. I was the chairman and CEO of TT. Now I'm a partner at an investment bank called Broadhaven. I'm also a partner at a PE firm called Seven Ridge. I'm board director of a bunch of fintechs that I believe in and that I've invested in. And then I do some consulting work once in a while for a TT or for a broker, RJ O'Brien, or whoever needs some help.
Tom Sosnoff, a founder of Tastytrade. Why don't you talk a little bit about yourself? But first, before you get into that, Tom is one of the more interesting people in our industry, and he's doing a keynote tomorrow, so I highly recommend joining Tom tomorrow night for his talk. Tom?
My name is Tom Sosnoff, and I started out in this business a long time ago when dinosaurs roamed the trading pits, and started off as a floor trader on the CBOE for about 20 years, and then I built a company called Thinkorswim. We were public, we were bought out by TD Ameritrade, and then I built a company called Tastytrade, and I still run the U.S. part of Tastytrade and Tastylive, which is our broadcast network, and so it's kind of been a long ride. I am incredibly bullish on this industry, and one of the reasons I'm here is because we're excited about expanding markets into different places. This is my second trip to Mexico. My first one, to talk about finance. My first one was to Guadalajara, and to talk to a group of students, PhD students and master's students and undergrad, and this time, second time here to talk risk and talk with you guys and tell our story. So, thanks.
And certainly last but not least, Troy Kane. Tell us a little bit about what you do at MIAX and where you see some of the growth going on in MIAX. And Troy, I talked about high frequency trading this morning. Troy's opening up a physical floor, so
Yeah.
That's going to be one of the more interesting discussion topics.
Yeah, that's slow frequency trading. Troy Kane, I'm the CEO of MIAX Futures. MIAX might be a new exchange brand down here in Mexico. It's actually the Miami International Securities Exchange. And it's started out as a U.S. equity options exchange. We now have 4 options exchanges in the U.S. We just launched our fourth options exchange last week called Sapphire, which will have its first trading floor in Miami next year that we're building out currently. And I think a lot of people will ask, why are we building a physical trading floor for U.S. options? Well, actually, trading floors are still utilized in the United States for trading options. About 8% of the option volume traded in the U.S. is done on a trading floor. And a lot of the complex volume that's traded in options is still routed to a floor, whether it's in Chicago or New York. And we're going to be building the first trading floor in Miami. So it's going to be in Florida, and it's going to be south of where the capital markets have traditionally traded in Chicago and New York. So we're very excited about that. But my role at MIAX is to transform our futures business. So we acquired Minneapolis Grain Exchange 4 years ago, which is a regional commodities exchange that trades agricultural commodities. And we're in the process of transforming that into a global exchange. Next year, we're going to be launching a portfolio of new products, new technology that's going to anchor on the MIAX technology. And we're very excited about the promise of that.
Well, let's kind of get to our discussion around emerging markets, and we've seen a lot of the growth in product, at least from my seat in New York. Given I'm pretty New York centric and London centric and European centric. It seems like a lot of the things that we've been hearing is really more about developed markets. But how do we, what's going on in emerging markets? I don't know, Phil. Futures is a global product. You've got a presence here. You're down here. How do you see growth in Mexico, LATAM, some of these other emerging markets, and are they growing? And how do we start thinking about getting them growing more?
Yeah, sure. Year to date, we've seen about 31% of our business at CME is from outside of the U.S. And we try to break that down and focus on how much of that is developed markets, EMEA, APAC, and what is the emerging market angle there. And what we're seeing is, we're getting traction. We have an office in Sao Paulo, and again, we have somebody, on the ground here in Brazil, in Mexico. Sao Paulo's in Brazil. And so our focus there is just understanding the different client bases. In Sao Paulo, there's a heavy agricultural angle. We market quite a few of our agricultural products. They do have a pretty robust hedge fund community that trades their financial products as well, and we see that growing. In Mexico, we focus a lot on the institutions, the pension funds, the Afores, trying to get some flow there into our markets and teach them how to use our products, as well as the banking community there, hedging like their U.S. Treasury holdings, and explaining how the U.S. Treasury market works, the Treasury futures market works, and how to price those and think about those relative to underlying instruments. And when we think about emerging markets, it's not just LATAM. We also see pretty good opportunity in the Middle East, right? When specifically Dubai and Abu Dhabi, they're trying to diversify away from just oil revenues and build robust financial markets and a robust capital market system there. So there's quite a bit of growth there. We don't have an office there yet, but I wouldn't be surprised if that pops up.
So is that flow more EM local or local, or is that more kind of plugging into the the U.S. liquidity pool? And how do we start thinking about how do we develop a local derivatives market?
Yeah, I mean, right now it's plugging into the U.S. pool. Locally, what we try to do at CME Group is partner with index providers or local IP to help promote products there and get cross listings. But that largely is up to regulators and regulatory hurdles on local markets in terms of getting products listed, getting folks approved to trade. And emerging markets have very different rules. I mean, we might talk about India later, but that's largely a closed market.
Mm-hmm. Tim, TT's global product, you're playing in the fintech space. How do you see emerging markets, and is that going to be kind of the bottom up from retail, or is it going to be from the top down on the institutional? How do we start figuring out how to build EM, and how do you start thinking about fintechs and technology plays there?
So what I'd say is what's happening in technology and what's emerging is different than where people are trading. But in terms of the people I'm talking to, they're definitely looking at the Middle East more. I agree with that, and a little more in Asia. But especially the Middle East, where I think that people are focusing their trading, and that's both from the U.S. and locally. And in terms of technology, it is interesting that you have this arms war of lower and lower latency, whether it's a microwave, now it's radio wave. You have FPGA playing such an important role now in a lot of these market data feeds. But then on the same side, literally have 3 or 4 different trading platforms going headfirst into retail. And so it's an interesting split as to what they're doing. And I think a lot of it is people are just looking for the next patch. And they see opportunities both for retail, being retail vendors for exchanges, but also opportunities in places like India and trying to go after that market. Yeah. And so, I think that's the interesting thing. And we can talk about AI later and some of these other predictive analytics coming up here. But I think that's the most interesting thing I've heard lately is the battle for low latency and then everybody shifting over to retail product.
Tom, you can certainly talk about retail. Do you think this building up EM is going to be really more about local, or really getting the EM local into global, more mainstream, not mainstream, but U.S., Europe?
It's a challenge that I think we face all the time. One of the reasons we sold Tasty 3 years ago is because I wanted to take it global, and I didn't think I could do it on my own, and I thought I needed lots of help and lots of licenses and lots of distribution networks and all that kind of stuff. And the challenge is still there. I mean, if anybody can ever solve the how do you create virality or how do you create, kind of distribution into places that it doesn't exist currently, they're going to be a huge winner when they figure it out. God knows I've been trying for a decade. I think that right now, 2024, with the massive amounts of liquidity that have been flooded into all the global economies through central bank, Fed, and everybody else, there's a better opportunity for us to expand, especially retail technology and retail trading. It is difficult to trade in marketplaces that aren't liquid, so bringing that business, to the U.S. right now is kind of the only option. I don't think that is the long-term solution by any stretch, but it's the only viable option right now because you need efficient markets to make something grow. But we are clearly in 2024, and again, one of the reasons we're down here for the next couple of days is because you can sense we're on the cusp of making something happen. Like we just launched our technology in London, we're about to launch our technology in 17 different countries, and that's how it starts. It starts there, it starts in academia, it starts everywhere, and it's kind of, it's organic, it's a little bit viral, but that's how it starts.
And Troy, you're trying to cater, with Sapphire and the floor in Miami to kind of the LATAM community. Do you see, natural demand like coming from Mexico and Brazil and some of the countries, down here?
I mean, MIAX has always kind of aspired to be a gateway to LATAM, by being in Miami and having a physical presence in Miami. I think as we grow our derivatives and we see that's really the asset class where we can grow, having access to funds and investors that are in Miami that are representing Mexico and LATAM is going to have a greater access point for us there. That's only one vehicle for why we're in Miami. I think for our futures business, we see a lot of opportunity to develop new products, new indexes potentially that can benchmark against equity and fixed income markets down in Mexico and other LATAM countries. I think that a lot of the investment class is trading a lot of cash markets, but they're not trading a lot of futures or a lot of index markets. I think that as the next generation of investors come into the marketplace, I think they want or are looking for index products or ETFs that can be benchmarked or used in their portfolios. And so we're looking to work with index providers to create some of those products that we can list on our exchanges.
Yeah, no. You brought up an interesting point. The whole ETF business has really been, in fact, the ETF business is, in some cases, it's more efficient to trade these things, like Brazil, stocks and U.S. ETFs, and that draws a lot of liquidity back, to the U.S. I guess the question is, how do we do that in return? How do we start thinking about how do we get, liquidity down? Now, I know you don't want to give up liquidity, but I think building these local areas is important. I don't know.
I mean, I think it's been talked about already on this panel. It's working with the local regulators. I mean, there's a lot of barriers to entry to get liquidity down into some of these countries. You have taxation, you have licenses that you have to get. Like it's a lot harder to go south than it is to come north. And so the first step is to build that bridge north and get the funds and the investment vehicles set up that replicate what you can do south, and then work with the local regulators or the brokers to try to change the landscape so that you can then have it go both ways.
Port those products south.
Yeah.
You can't really talk about EM without talking about India, especially now. There's crazy stuff going on in the Indian, actually, options market. I don't know. Phil, you've got a global presence. Do you have any perspective on what's going on in India?
India is that's a tough nut for CME Group, right? It's largely a closed market. There's some institutions, corporates that can trade outside of India, but all of the growth they've seen, it's mostly equity option related. And in 2018, roughly 2% of their volume is retail, and now it's about 41%. So when you think about all that flow, 41% of that is retail. They're very small contracts, so that's why they have a lot of volume. But even the Securities Exchange Board of India, the SEBI, came out with some recommendations in terms of how to put more controls around the market, increasing contract sizes, limiting expirations, things of that nature to try to rein it in a little bit. So it's not clear how to crack that because, like I said, at this point, it's still a closed market. All of that flow can't come outside of India.
Yeah. Tom, there are options contracts here in the retail options space. What do you hear? What do you see? Are you thinking about India as one of your markets you're going to look to open?
I think about India more than anybody else. I think about India more than I'd like to. It's a little crazy. So a couple of years ago, actually 2 years ago, I went to Mumbai to give the keynote at the Bombay Stock Exchange on derivatives trading. And the crazy thing about India is that, so we have on a daily basis over 10,000 viewers that watch Tastylive from India that we cannot monetize at one bit. And the markets over there are very restrictive, just like Troy was saying before. From a regulatory side, it's almost impossible for U.S. companies to do any business unless you're in a partnership, and even that's really hard. But I do the second largest, I'm an advisor to the second largest online brokerage firm in India, and the CEO actually used to be a developer for us. So I'm very familiar with kind of the patterns and the number of people that trade. I mean, they have 12 million customers. They trade a ridiculous amount of contracts just as one firm every day. They're small. And
When you say small, how small is small?
the contract size is super small. Like
Like a buck, $10
yeah,
bucks?
Yep, like the equivalent of, $1, $2, that's it. And the notional is really small. So like, in the US, like especially with futures products, the notional could be, the S&Ps, the notional is, $250,000. NASDAQ, it's 400,000. And when you talk about in India, you're talking, they don't really have, the futures market's tiny, but the option market's big. And the notional is, in the hundreds of dollars to thousands of dollars. So it is a huge challenge, but there are, there's millions of people that trade that want access to different marketplaces, but there's regulatory hurdles. They have regulatory hurdles around digital assets. They have regulatory hurdles around moving capital out of the country. It's almost impossible, so it's hard.
Mm-hmm. But is that the key to kind of, some of the stuff we think about, coming in and getting, folks into the U.S. or whatever, but, is it the small contract size? Do we build up the retail base? Do we put things on cell phones so that people without landlines and stuff like that can trade this stuff?
What's happening right now in India is like a blueprint for what's going to happen in other countries all over. But, India's had this massive capital growth, and it's exploded into their marketplace, and they have created some, localized liquidity and localized efficiency, and their market exploded. That's going to happen all over the globe. But, in order for us, we truly have to take down the borders. Like, this can't be hey, I'm trading in the US or I'm trading in India, whatever it is. It has to be much more, think of it a little more in decentralized terms, but it has to change. It will change too, because there'll be too much pressure on the regulators to change it, but so far it hasn't happened.
Troy, you spent a lot of time at some global unnamed big trading firm that traded everywhere. How do they think about it? Do they, they have a huge retail business. Would creating, in effect, a retail infrastructure kind of help percolate, some of these EM businesses? Or is it just come with job growth and company growth and,
It all stems from education, one, in helping the next generation of investors understand how to trade. Also, technology's been a big part of it. Like, they have more access to cell phones. Everything's on an app. They have the ability to set up an account, trade. To Tom's point, you can trade with lower capital requirements today than you could before. Market makers are able to provide liquidity much easier because it's more scalable. It's more electronic than it's ever been before. Mm-hmm. There's more exchanges that exist today than existed before. Even in India, if you want to keep using that as an example, their exchanges are evolving, becoming more electronic. You look at China, you look at Korea, you look at even countries like Turkey. The growth of single stock futures in Turkey has been pretty remarkable to see, actually. I was actually having a conversation with the Mexican Securities Exchange today, and they're seeing great growth in single stock futures here in Mexico. So you're just seeing like a really good evolution of education, technology, and more investors coming into the market, and it's just a perfect storm of circumstances.
Yeah. Tim, we're talking tech. I can't not bring you into this. How do you see that playing out? Are these guys right? It's going to, you start at a ground level. It's going to be on the apps. It's going to be on crypto or some other more decentralized type technology. How do you see this playing out with some of the opportunities you're seeing?
So, I see a couple different trends with these trading platforms. First, it's a race to who could go all the way from front office all the way to back office. I see more and more companies want to do that. So in other words, they don't have
stack.
What? Front to back. Absolutely front to back. So let's call that vertical. And then on the horizontal side, I see a lot of these platforms now wanting to be additional asset classes. And so now it's just complicating everything because you're going to go front to back, and you're going to be adding additional asset classes so that you can have that spread. And then on top of that, though, you now are having more and more outages with these trading platforms. TT, for example, had the longest outage of its entire existence just this year in February, and had another one in August. And they're going to continue to happen because it's almost like they're trying to juggle too many balls, and the technology at some point, especially if it's cloud-based, SaaS-based, it's going to be a problem because, and the biggest problem is that if it's not configured right, if one goes down, they're all tied to each other. They all go down.
Yeah, when I was at Lehman, I built technology for them, and I've specifically worked in fixed income U.S. product, and the equity system was completely different. The European system were completely, it's hard to do that. Front to back, horizontal, multi-asset, multi-geo, multi-currency. That's not an easy thing to build out. That's really tough.
I totally agree with you. And let's see what happens. I do know, though, that you're going to see these regulators more. And I talked about it a little bit this morning. You're going to have more and more of these regulators saying you have to have a backup. You have to have some resiliency, because if you don't, and a bank is out of the market, it's millions and millions of dollars per minute. And so it's becoming a big problem, especially when you have like 3-4 day outages.
Yeah. What are the things that, Tom, you focus on, especially given Tasty, is risk management? As you start building a derivatives platform with leverage, it's nice to have people trade, but it's nicer not to have them blow up. How do you start thinking about managing that, and especially as you get into more leveraged products and extend into futures from options, how do you manage that?
Well, risk is, you're probably not going to love my answer here, but risk is something that, of course, obviously challenges everybody, but the marketplace, the regulatory requirements essentially set the risk parameters on the retail side. It's very different on the professional side, because the professional side has a lot more leverage. But on the retail side, the regulators essentially set the minimum requirements, and then the firms can go higher than that if they want to. So for us, we're essentially sitting at a 2 standard deviation move every single day across the board. And what we try to explain to customers and implore is just, if you want to protect yourself, the best way to do it is to stay small. I mean, I know this sounds crazy and it sounds so simple, but most people, the only people that really get in trouble on a retail side are people that are too big, that are over leveraged for the size of their account. Because again, in the retail world, you can't go beyond a certain level. And in the overnight requirements, they're set the same for every single firm. So it's not like we have a lot of say in risk. I mean, obviously some firms have better risk tools than other firms, and I'd like to think we're among the best there. But the reality is that every firm on the retail side essentially has the same requirements, and those rarely change with moves in implied volatility. So when markets get wild, the risk just goes up a little bit, but you know what? There's also more noise, there's more participation, and there's more opportunity. So I think that it's a fair trade-off. Let's put it this way, Larry. We don't worry about risk on the retail side. It's a much bigger concern for tech firms. It's a much bigger concern for institutional firms. On the retail side, it is what it is.
Phil, risk is probably outside of Globex and your trading platform the biggest thing you manage. Periodically, how do you look at it? How do you guys manage it?
Yeah, we have a risk committee in the clearinghouse, and they're running a multi-factor model daily to determine if margins are set appropriately given the volatility we're seeing in the marketplace and other factors. When we have periods of extremely low volatility, like for example, when we were in a zero rate environment and you had some of the front month Eurodollar contracts that weren't moving, right? The model would indicate almost no margin, but there was a floor, $1,000, $1,500 a contract. You had to put something up. The clearinghouse primarily just monitors the market and sets margins. Our FCMs are all free to charge more. They can't charge less than a minimum. But like the event on August 5th, there were several FCMs for their clients that did raise margins above exchange minimums. Now they don't keep them there long, but that's to protect themselves on top of it. And the thing is, when you think about margins, like even the micro contract, the S&P 500 micro E-mini contract, that's about a $27,000 notional contract. And that's a retail contract. And, the exchange minimum on that margin is like $1,380, $1,380. So, right, if you are able to post that, there's not much of a move before you're underwater. So, back to Tom's point about staying small, like you should never post as a retail trader the minimum amount. Like you should always be able to absorb a much bigger loss than that and keep your positions.
So from a macro standpoint, are you worried more about the little firms, the medium-sized firms, the big firms, or this is just kind of built into the fabric of the clearinghouse?
Yeah, the system has worked well. You go back all the way to 1987, right? Like we were able to open the day after the crash, like massive margin calls, but all the margin calls were met, and the market reopened. Maybe by not much time, but it reopened. And then you think about all of the the volatility in markets since then, and even leading up to 2008, which ultimately why it was written into Dodd-Frank to have all OTC IRS plain vanilla interest rate swaps cleared out of the exchange, because the exchange model worked.
Right.
Like nobody blew up at the exchange, and even with the volatility we saw in COVID, it gets hairy and there's margin breaches, but at the end of the day,
it works.
The system works.
It works. Talking about risk, let's go back to Tom and maybe Troy. Talk about education. Where does education fit? I know Tastylive is a lot about education. How does that play into kind of getting folks onboarded, and how would that play into like emerging markets, derivatives growth?
So my answer on investor education is, and you might not love this one either, I love content, and I think in 2024, the world's changed. Investor education traditionally has been very static, and because it's static, it's one of the reasons that we've transitioned so slowly from passive to active. If we focused on content that, to me, is very dynamic, that changes all the time, like what we do is we're a think tank, and in a think tank, we're constantly creating new content because whatever we created 6 months ago or a year ago or 5 years ago, to me, it's outdated already, and we need to move. So what we do is we don't call what we do education. We actually call it, we just create content. And
so by content, do you mean like trading ideas?
No, not trading ideas necessarily. Optimizing mechanics. So for example, let's say you wanted to trade a futures option. What is the optimal duration? What is the optimal delta that you want to buy or you want to sell? What is the optimal strategy for something? And prove that. Like, the one great thing about derivatives is that the derivatives market is not black and white. It's not a static marketplace. If you can be wrong and you can make money, you can be right and you can lose money. And because of that, it becomes this strategic marketplace. And therefore, there's mechanics that go along with strategy. And I think that's what turns individual investors on, is knowing, hey, you know what, I can be a little bit different than just something that's pure black and white. I can be strategic. And for that reason, they get engaged with the content, which effectively is like a sister product to education.
That's really interesting. Just a really different spin on the classic, hit this button and do that. Interesting. Troy?
I was going to say, I agree with Tom. I think also with the growth of technology and applications, I think that we're seeing more analytics coming to market and more available to investors, that they can kind of model out things more and simulate portfolios or projected outcomes of trades. And I think that, to Tom's point, if you can give them content that they can go and kind of play around with things and then go and then execute on it and see if it actually returns what they simulated, and then post-trade analyze that, I think it gives them something to go to be a more active trader, instead of go and trade it and then come back, at the end of the day or the next day and see what they made or see what their returns are. And I think that if you can engage with investors more actively, then they're going to be more active in the markets and they're going to trade more. And as an exchange, I want them to trade more because I want them to turn over volume.
Tom, you want to hop in?
People are really smart. People that end up with a certain amount of wealth and excess capital and liquidity and things like that, and liquid assets, they tend to be very smart. And they don't want to hear your version, when I say your, I just mean anybody's version of, especially from financial media or anybody else, they don't want to hear their version of some macro story on why something's going to go up or down, because they know it's completely subjective and they know that it's random. I think what really turns people on when it comes to finance, this is one of the reasons for the growth, the huge growth in listed options and futures options, is that we have introduced a generation to the quantitative side or the math side of finance. And in that case, they can use skills that they've learned through academia, skills that they've just acquired, street skills through life, and it becomes much more of a game where the numbers make sense. Okay, the chances, rather than telling me a stock is going to go up or down, just tell me exactly what the expected move is based on implied volatility, which is a real number, which is a theoretically accurate number, and then all of a sudden you gain somebody's interest. And that's where we've gone from 20 years ago, which was just kind of like read these charts, to where we are today, which is, what is the expected move, or what is the implied volatility, and what does that actually mean? And it's actually pretty interesting. And that's why we've had this huge growth.
And so I guess they're looking at the market and saying the market is saying the implied volatility is X, but you do the math and it says Y, but I don't believe Y. I believe Z or something like that, and make a play to kind of off against X and Y or whatever.
Sure. I mean, in the trading pits for years, we didn't really care why something happened. You're just trading off order flow and math and stuff like that. But it's now finally gone global, and it's really changed all the market structure, and that's why people have gravitated towards capital efficiency, and that's why they trade options. That's why they trade so many futures now, is because people realize, oh my God, it's the same exact product, it's just more capital efficient, so I have more money to use for different things, which means law of large numbers comes into play, which again gets back to this math equation.
Phil, you were talking to me, back there about the growth in options on futures. We worked at Tabb Group. We worked with you to try to write some stuff about this product. I don't know, 10, 15 years ago, and it was like, why isn't this moving? Right. It seems like it's finally moving. What's going on with the options on futures business?
It's been a long road, but we've seen much more institutional adoption. That's what's driving the big numbers. You'll see, if you look at holdings reports, 10Ks from a lot of the big bond fund managers or equity managers, you'll see substantial options positions in their holdings, and they use them strategically, right? If they feel like, okay, if rates go any higher, I'm a buyer of bonds here, right? Volatility is at a healthy level. They think maybe volatility is too high. They sell puts, right? If bond prices fall, yields continue to rise, they're happy to buy bonds at that level. If the market stabilizes, they collect premium, but they use these types of strategies to generate a little extra income, and it's created quite a few opportunities in the marketplace and growth.
Interesting. Tim, let's talk about some fintechs. What are some of the more interesting ideas that are, coming by your desk that you may or may not be putting money into, or what's some of the more outside stuff?
So what I'd say is, and it was apparent to me when I was out trying to sell TT, a bunch of exchanges showed up, and they were very interested in the TT traded data, and they believe that if you get a hold of that kind of data, you could monetize it by starting in the world of trade signals and stuff like that. And so I think that's where I see a lot of fintechs blossoming right now, is trying to take data, especially traded data, and turn it into trade signals. So I'd be surprised if that you don't start hearing more and more press releases on that. Already they're predicting a CPI, but maybe that's not that big a deal. But they're predicting a CPI a month out with 96% accuracy. But if they start doing other kind of predictive analytics, then maybe it's more interesting. But the thing that I'm also most interested in, you talk about risk again, I think that's where everybody on the professional side, because I agree with what you said, Tom, the retail is a different story, but the professional side, to me, it's just, it's a ticking bomb just ready to blow up. And all these risk managers, they don't sleep at night. They're especially if they got global firms. It's hard to predict. You don't know when it's going to happen, and all of a sudden it's on you, and you have to survive. And so I think anything we can do to have proactive or more proactive risk platforms, I think is going to be helpful for us.
Interesting. So predictive analytics, that kind of gets us to AI. I don't know, Tom, are you seeing AI come into, to your world, or is this still more, statistical analysis and, hedging?
Every firm has put a certain amount of capital into AI. Our firm's no different. We're launching our first AI bot. I think we just launched it. But the challenging thing with AI is that when you're a regulated firm and you deal on the retail side, I can't speak for the institutional side, but on the retail side, we have to be very careful because AI cannot make recommendations. AI can't do certain things. Not that I think it would be effective anyway, but I think that what AI will do is it will speed up the search process dramatically for working your way through content. So somebody, for example, that wants to learn about trading, that wants to understand strategies and optimization and mechanics and all that kind of stuff, they can get from point A to point B in about 1/100th or 1/1000th of the time that it took before. So, you go back 20, 30 years ago, it could take months or years to train somebody about markets and trading. You fast forward to where we are today, you can do it in a matter of minutes, hours, weeks. And so that's where AI really plays an incredibly valuable role. And I think that's what you're going to see the biggest returns from, at least in the online retail space. That's all I can really talk to.
Troy, you worked at a firm that spent a lot on tech, now you're at MIAX. Where do you see AI fitting in? Do you see it, taking over, the human traders?
I don't think it's going to replace trading or algorithmic trading anytime soon. I agree with Tom. I think what it does is it just accelerates a lot of the processes that, cloud computing or algorithms are doing today. AI is only as good as the data that's inputted into the models. It's large language models, right? They're still learning, they're still evolving. I think everyone thinks they're going to take over or they're going to be able to replicate what humans are doing. I think we said the same thing about algorithms 20 years ago. Traders are still needed in the industry today. I think that we all thought that electronic trading was going to replace traders when the floors got shut down. So I think AI, has a lot of utilization in finance, but I think we're still learning and figuring it out.
The only thing I'd say is that I'm not talking about AI. AI is only as good as the data, right? And so when we're talking about AI, it's just a machine to manipulate the data. The question is the quality of the data. It's the whole garbage in, garbage out thing. Yeah. And so can you derive predictive analytics if you've got the right data and then a data scientist? Let's call it data science instead of AI, if that helps. And can you take that traded data and start seeing patterns in which to trade on?
Just to carry on that, I think where AI is going to be used in trading firms is in a lot of trade research, right? Quant research and post-trade research and trend analysis and predictive analytics and, a lot of what's being done, today that takes a long time to do or takes a lot of manpower can be accelerated. But to Tim's point, it's only going to be as good as the data that's being inputted. And I think that's still being engineered today. And I think that you pair that with cloud computing, I think that, we're going to see a lot of great things come out of the industry in the next few years.
Yeah, while you talk about cloud, there's been a lot of discussions, and Phil, you guys made some investments, or Google's made some investments in you, or you've made investments in Google. I'm not sure exactly how that works out. But where are we with cloud and exchanges and exchange infrastructure? Because, typically, you're looking at determinism and you're looking at latencies, and, if the matching engine is who the hell knows where, how do you manage that? But, what's going on with you guys in cloud?
It's still very early days. Google made an investment into CME Group probably about 3-4 years ago. Now it was $1 billion investment. And so we've gone down the path of starting to build out, what does it mean, CME in the cloud? We have some data offerings there now and are moving parts of the business there. But ultimately, and we announced a few weeks ago, that we're going to be moving the match engine to the cloud. And that's the heart of what this deal is about.
What does that mean? Does that mean that you're going to have a virtual instance of Globex, or does that mean that you're going to move to more Google technology, kind of cloud technology within Aurora or whatever, the data center?
And it's a brand new data center, and it's going to be managed by Google. Google's going to manage the data center. And what, the ultimate goal here is to just bring down the barriers to entry, right? Because to join the markets now and become co-located, it's quite expensive. It's a cumbersome process. The vision here is to make it where any small shop can allow Google to manage the process and just pay a fee and have the same advantage as any other trading operation that is heavily invested in co-location.
Would that be in this new data center, or so co-location kind of takes on a different name, or does would Google be able to manage me from Idaho to
It would be in the new
Chicago?
data center. It would be in the new data center.
Mm-hmm.
The old one will eventually go away. I mean, there's no timeline for that yet. But our CEO has also been very clear. If latency and some of the other key factors that are very, very important, especially to the high-frequency traders, like if that's not all on par, as good as it was, then
He ain't going.
he's going to hit the brakes on it until the technology is proven. And we're several years away.
What's MIAX's strategy around that, or do you not have a strategy?
No, I mean, we've been utilizing cloud for a lot of pre- and post-trade services, as I think most exchanges. I mean, we have no near-term plans to move matching into the cloud. I think maybe CME or NASDAQ is doing currently, but we're always evolving leading-edge technologies. I mean, MIAX has kind of always been on the forefront of utilizing technologies to optimize trading. But right now, we still think that on-prem matching is the right model. But, we're always evolving. But we are already using cloud services for pre- and post-trade, so.
Let's see. I don't know. One of the big things, that's come back down recently, you talked a little bit about the micro minis. How is the growth in that? And Tom, I guess let me bring you into this. Are these products that your guys are interested in? And,
Yeah, I mean, that's been a huge growth product for us. We launched it, for the retail community, and we have micros in all asset classes. They do best in equities, energy, metals. Rates micro product, not so much, but probably because you get more bang for their buck on the other asset classes. But yeah, it's been a huge growth part of our portfolio. There's a ton of, the emerging market economies or the emerging market clients trade primarily micros. So, now we're just trying to develop the options market on it. But Tom probably has a better perspective on micros than I do.
are you seeing demand for the micros?
Yeah, I mean, we have to go back a little bit. So going back into around 2005, when we built Thinkorswim, our customers were like, we'd love to have a smaller futures product. So we started presenting the concept of micro futures in 2005, 2006, 2007. And I actually got in a big fight with Terry Duffy over that, and he told me to go jump in a lake, and I told him kind of the same thing. But we fought about this for almost 10 years. I fought with the SIBO, with the CME, over launching micro futures. I finally got so frustrated that we built our own exchange called the Small Exchange to launch micro futures. And then when we did that, then the CME came out with micro futures. So I've been a huge proponent of it for, going back for, I want to say just almost 2 decades. The market needed it. It needed a product for retail investors that was reasonably sized notionally. And I mean, to be fair, markets never look back. It's our fastest area of growth in the future world itself. Our fastest area of futures growth is actually futures options, not in the micros, but of futures products themselves, underlying futures, it's micros.
So options on futures.
Options on futures is our largest growth area in the whole business, but when we're talking about futures alone, it's micro futures, for sure.
Interesting. We're kind of running out of time. We have some questions.